Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lesson on accounting for materials by looking at stock valuation, or what we may call inventory valuation. And this valuation that we are going to look at, we are looking at it in relation to receipt and issue of inventory into store. Now, what we do in a typical organization is that the storekeeper, or the one in charge of the stores, maintains a book called the store's ledger. Now, inside the store's ledger is when, most of these organizations that are into manufacturing and selling of goods are such that they buy raw materials or inventory and then they put it in the stores and they issue to the production department for production. Now, apart from that, even with a normal trading organization who deals in inventory, most of them buy the inventories and then sell it out. Now, the issue here that we have to tackle now is about how we receipt inventory into store and how we issue out inventory to the production department for onward transformation into finished goods. We can also call this topic pricing of inventory. So we can say inventory valuation or pricing in terms of coming in and going out. And we have so many methods that can be used to do this inventory valuation. We have the FIFO, which is the first in, first out. The methods of stock valuation, that's what I'm talking about now. Methods of inventory valuation. As far as the stock's ledger preparation is concerned, we have the first in, first out method, which we call FIFO. FIFO is an acronym for first in, first out. And then we have LIFO, which is last in, first out. I'm going to explain them and then I'm going to tell you which ones will be applicable. And then we have the simple average method. And then we have the weighted average method. So we have two different types of average methods. We have the simple average and then we have the weighted average. These four are the most popular ones. Of course, we have so many other ones. We have the replacement cost method. We can also have what we call the standard price method. It can go on and on and on. Now, my focus with this lesson is basically on two. That is on the first in, first out and the weighted average. That is what I'm going to do with you now. Because with the last in, first out and the simple average, usually for these ones, there are extra ones. Well, we'll talk about them later maybe. But for now, I want to focus on the first one and the fourth one. The last in, first out is really not applicable in a business sense. In a sense that mostly, especially when you are dealing with perishable goods, it will be a problem. Now, the first in, first out means that the goods that arrive first are the ones that should be issued out first. So let's say you brought in 100 pieces of goods today. Next week you brought another 200. Now, the general rule with the first in, first out is that you need to sell the 100 that came first before you come to sell the 200 that came later. Or if you are issuing from stores to production, you need to issue out the 100 that came in first before you issue out the 200. Now, the issue over here, or the main important factor here, is not really about the stocks that is going out, but it's about the pricing of the stock. That is why I say we call it stock pricing. It's about the pricing because these inventories will come in at different times and at different prices. And so if the first 100 came in at 5 cedis or $5 per stock, and then the next 200 came in at 8 cedis per inventory, and someone, or you are issuing it out, or someone is coming to buy from you, are you going to sell at the 5 cedi or you are issuing it at the 8 cedi? That is a question to answer. And we are trying to say that for the purpose of pricing, you need to sell it at the first price. So the first 100 must go for 5 cedis before later the 8 will also come. So that is what we do with stock valuation. Now, normally with this topic, we focus mostly on stores to production. That is what we talk about. However, we'll also look at other aspects where we'll look at profitability issues. But for now, let us consider issuing it out with a pricing. And we want to consider the first price that came in should be sold out first, or should go out first before the later price will go. That is what we call first in, first out. Now, last in, first out means that the one that came in last must be sold first. And you know, when you are dealing with perishable goods, you may end up wasting the first goods that came because it may never go out, or expiry dates may even catch up with it. So what we are trying to say is that the last in, first out is really not applicable. Now, when we come to the averages, with the averages we have the simple average and the weighted average. Now, in practice, the simple average is not very logical, and it's not really prudent. And so we always want to stick with the weighted average method. And so in principle, we are trying to say that the first in, first out method and the weighted average methods are the two methods that are widely acceptable. And that is what we are going to deal with. So I just listed these methods to let you understand that there are other methods. Of course, I could also take, in fact, the same questions, I could use all these other methods to solve one same question. But what I want to focus on is to focus on the first in, first out and the weighted average method. And so that is what I'm going to focus and explain now. So what I'm going to do now is that I'm going to take a question straight away, and I believe that it is more understandable when you are solving a question with this type of question than just to talk about it without a question. So I'm going to give you the format for the stores ledger. So you say stores ledger. Stores ledger. So I'm going to use the FIFO method first, and then afterwards I'm going to use the LIFO method. But the format is the same regardless. So stores ledger. So this is how to go about that. Watch how I am drawing the format and learn. So then what I'm going to do now is that I'm going to divide each of these spaces by 2 horizontally, and then I can divide this by 3. So I'm creating 3 columns for each space. Watch and learn how to draw the format for the stores ledger. Alright, so this is what we do. This is the stores ledger. This column will be the date column. And then we'll call this place receipt column. And then issues column, where we issue out, we receive, we issue, and the last column will be the balance column. So we have 3 columns with receipt, issues, and balance, and the date to get up for all of them. Then under the receipt, we have 3 different columns under receipt, 3 different columns under issue, and then 3 different columns under balance. So under the receipt column, we will have the quantity, we have the unit price, and then the total amount. The same for the issue, we have the quantity, we have the unit price, and then we have the amount column. The same for balance, we have the quantity, we have the unit price, and then we have the amount. Okay, so this is a typical stores ledger, and then I'm going to use this format to solve a question with you right now. And so let me show my currencies. I'm working in dollars, so the currency sign will be under the amount column and then the unit price columns. So currency sign. All right, now I'm going to solve this question with you, and I'm going to use, for the same question, I'm going to use the FIFO method to solve it. Then afterwards, I'm going to use the weighted average to also solve it, and then we can appreciate those 2 methods. When we are done, in the next video, we are going to talk about how to calculate profit and make decisions with them, and we are going to make the question a little complex. So this is it for the stores ledger. Okay, so let us take this question. You are appointed as the storekeeper of some care limited. Use the information below to prepare the store's ledger account. Use the information below to prepare the store's ledger account using both the FIFO and the weighted average methods. Alright, so these are the transactions. June 1st, opening balance. We have 60 units at $4. And then June 2nd, receipts of 100 units at $5 each. And then June 4th, another receipt of 50 units at $6. Then June 7th, there was an issue of 40 units. And then June 10th, there is a receipt of 150 units at $8. June 15th, there is an issue of 130 units. And then June 18th, there is another issue of 90 units. So these are the transactions. And as you can see, you realize that with the receipt, there were price per unit were given. But with the issues, they didn't give us any unit price. Now, what it means is that when you are issuing out, you are going to look for the pricing method. And that is where FIFO and the weighted average comes in, because they are pricing method. The purpose is to look for the price to issue out the goods. That is the meaning. And so you don't really need price with the issue. However, there are some instances where you'll be giving price with the issue. When you are giving a price with the issue and you are dealing with FIFO and weighted average, please don't use the price giving. Ignore that and still go by your own pricing method. Except when you want to prepare profit or loss account, which I'm going to talk about in the next video. But for now, just note that the price that you are going to use to issue will be determined by the method of valuation. If you are using the first in, first out, you know what to do. If you are using the weighted average, you know what to do. This question instructs us to use both methods. And so I'm going to begin with the FIFO. We cannot do the two together. We need to first do the FIFO and then later we'll do the weighted average. And so store's ledger, let me put into bracket FIFO method. Alright, so we are going to begin this question. Now on June 1st, there was an opening balance of inventory. That is the balance brought forward. So this is how to record the opening balance. The date is June 1st. So it will not come under receipts because you are not receiving any in the inventory. This one is not also an issue. It is a balance. So you skip received, or you can call it received instead of receipt anyway. So issue or receive, no, you come to balance because it's an opening balance. Then we were told that it was 60 units at $4. And so under quantity you put 60, under unit price you put 4 because it's $4. For the amount column, you are going to multiply the 60 by 4 and then you put it there yourself. So that is how to record an opening balance. There is no narration over here. So 60 by 40 will give us 240. Alright, so that is the amount. And then we are done with the first transaction. As easy as ABC. Then we move to the second one. Says June 2nd, received or receipt of 100 units at $5 each. So it is a receipt or it's received. So it goes under the receipts column. That's the meaning. So June 2nd, the quantity is 100 units and the unit price is 5. So you put 100 units. Alright, so let me say this before. Now, once you finish with your opening balance, it is always proper to underline that as well. And I'll explain to you why you need to underline it. Every transaction that you record, just do the underline. It's very necessary to help you in differentiating the others. So, June 2nd, there was a unit received of 100 and the unit price is $5. So, you multiply 100 by 5 and then you have $500. So that is it for June 2nd. Now, let me tell you this. Just like the bank statement, every receipt or issue must reflect in the balance. And so once there has been a receipt of 100 at 5, we need to put that under the balance. So watch this. We put the receipt of 100 at 5, we multiply to get 500. Then we come to the balance. When we come to the balance, you already have 60 at 4. And so you need to repeat that. 60 at 4, 240. Before you bring in the current one to add up, don't mix them up. Don't add them. This is the essence of the first in, first out method. If it was the weighted average, you could have just added that and then find our average. But please, we are doing first in, first out. The reason why we cannot merge them is because the prices are not the same. And so that is what we are doing. And we need to repeat this 60 at 4 first. That is why I advise you to underline it after that. Because if you don't do, you will be misled to think it's already there. So you are bringing your 100. And that will be a disaster. You need to repeat it again under every line. So 60 at 4. Then you can now bring your 100 at $5 for 500 cedis. And then you can underline again to show that you are done with the transaction on June 2nd. That is the meaning. And then we move on to the next one, which is on the June 4th. June 4th, receipts of 50 units at 6 cedi each. So there is another receipt on June 4th. So June 4th. And the number of units is 50. So 50 units. The unit price is $6. And so when we multiply 50 by 6, we have $300. Now we come to the balance again. When we come to the balance, remember that you have to repeat both 60 and 100 first before you add up the third one that just came. I hope we are okay with that. And so you say 60 at 4 is there for 240, and then 100 at 5 is there for 500, and then we just brought in another 50 at 6 for 300. Now, once you are done with that, you underline. So in store, you have 3 different inventories coming in at 3 different prices. And the next one is going to be an issue. And this is where we are going to look at the price to issue. Now, after that, the next transaction is on the 7th of June. And it is an issue. We are issuing out 40 units. So now we have to issue out 40 units. We are using FIFO method. So you see, whether FIFO or weighted average, the headache comes when you are issuing, not when you are receiving. And so on June 7th, we have to issue out 40 units. And because it's an issue, we record that under issue. All right. Now, 40 units. The principle is FIFO, first in, first out. So you have to look at your previous balances. Which one came in first? The one that came in first must go out first. And we are issuing 40 units. And looking at the 40 units, you could see that the 60 came in first. So we have to first issue from the 60. So the 40 units will go out of the 60. Fortunately for us, all the 40 can be taken out of the 60, and they will even have a balance of 20. And so we can issue all out of the 60. And so if, okay, don't worry, there is another scenario. So under quantity, we put 40, and then the unit price will be 4 because we are issuing it out. Listen, the unit price is the most important part. You are issuing out 40, but it is coming from the first 60. And the first 60's price is 4. That is why I'm putting 4 here. So when I multiply 40 by 4, I have 160. This is because 40 can be issued out of 60 and there will still be a remainder. There are cases where the amount of inventories or the total number of inventories to issue out is more than what is there. So you issue it part by part. The first part goes out of the first one. The other part goes from the second one, which I'm going to show you in the subsequent transaction. So for now, we are issuing out 40. Remember that it is first in, first out. The 60 came in first, and so it must go out first. That is why I'm using the price corresponding to that to issue. Now, when I come to the balance column, this is what I'll do. I issue this 40 out of the 60. So the 60 is remaining 20 now, because I issued 40 out. So 20 at 4 is going to give me 80. Okay, and then I'll repeat the other ones. 100 at 5 was not touched, so it will be maintained. 50 at 6 was also not touched. 300 will also be maintained. Then I can underline my ledger or my entry. So this is how to go about the issue. First in, first out. This was in first, so it went out first. Now look at the next scenario. On June 10th, there was another receipt, 150 units at $8. So June 10th, there was a receipt of $150 and 150 units at $8. Now when you multiply 150 by 8, you have 1,200. So when we come to the balance column, we have we have to repeat all that is there first. So 20 at 4 gives me 80, 100 at 5 gives me 500, 50 at 6 gives me 300, and then the new one that came in, 150 at 8, gives me 1,200. And then I can underline it. Alright, so this is the way to go. Now let's look at the next transaction. June 15, we issued out 130 units. Which price are we going to issue out? 130. We have 4 different stocks in balance. We have 4 different inventories in stock at the balance column. We have 20 at 400. They are all at different prices. We are issuing out 130. Now, if you are issuing out 130 with the principle of first in, first out, it means that the first 20 will go out first. We are issuing out 130. So if the first 20 goes out, how much more do you have to issue? You have 110 more, because if you take 20 out of the 130, you still need to issue 110. Then you move to the next one, it's 100. So the 100 will also move. You still be left with 10 to issue. Then the last 10 will be taken out of the 50. So this is how to go by the first in, first out. I repeat, we are issuing out 130 per this one. So 130 with first in, first out. The first in is 20, must go with a price of 4. Then the 110 that is left out of the 130, this 100 cannot issue all. So we issue all the 100 out, we will still be left with 10 units more to issue. Then we can move to the next one, which is the 50, and take it out from there. That is the idea of first in, first out. So the date is on the 15th. So June 15th. This is how I'll go by it. I'll first issue out the 20 at 4 under issues column. Then I put my 80. Then I'll come to issue the 100 at 5. We still don't write that together. We do each of them separately. So 500 is gone. We still have 10 more to issue. So the last 10 will be taken out of the 50. So I'll put 10 at 6. The price is 6. Please pay attention and don't get confused. So that will give me 60. Then I come to the balance column. When I come to the balance column, you will see that 20 is gone. The 100 is gone. The 50, 10 is gone. We are left with 40. So I'll start from there and put my 40 at 6. And my 40 at 6 is going to give me 240. 240. And then the 150 was not touched. So 150 at 8 remains the same, 1,200. And then I am done with the issue. So you see how we did the issue. We first had to issue the 20 because it was the first. Then we moved to the next 100 also went out. Then the 10 that was left was taken from the 50. And that is why we have a balance of 40 for the third balance that was originally available. Then we can now underline this as well. So this is how to go by the first in, first out method of inventory valuation. And then we are going to look at the last one, which is on the 18th. Issues of 90 units. And so we are going to do an issue on the 18th, June 18th. We are issuing out 90 units. Still using first in, first out. 90. So the 40 must go first. After the 40 goes out, we have 150 and we take the extra 50 out because 90 will be 40 plus 50. So we are issuing out 90, but we cannot write all the 90 at a go because of the pricing, different prices. So we'll say 40 at 6 for 240. We issue that out first. Then we can now issue a balance of 50 from the 8 cities. So 50 at 8 and 50 at 8 for 400. And so when we come to the balance column, the 40 is already eliminated. And out of this 150, we have issued 50. So we'll be left with 100 units at 8. and that's going to be 800 units. And then we can underline that, and then we are done. So ladies and gentlemen, this is how to go by the FIFO method of stock valuation. And when you are done, one thing that they are mostly interested in, or decision makers are interested in, is the closing stock balance. So now we have a closing stock of 100 units at 8, giving us 800 cedis value. So the closing stock for FIFO is 800 units. $800, sorry. 100 units at $8, giving us $800. That is the closing inventory. Now, when we are done with the weighted average, we will look at the value of the closing inventory. That is where it will lead us to the next video, where we are going to look at the profit or loss in regarding to either FIFO or weighted average. Because the FIFO has given us 800 cedis value for our closing inventory of 100. When we do that, we are going to use the weighted average to solve this same question. But you will see that we are going to get a closing stock of 100, but the value will not be 800. It will be different because of the method of valuation. And that is where we are most concerned about the profit, which of them will spark a higher profit. And then we'll talk about that in the next video. Alright, so we are going to use the weighted average method to solve this same question as it was required. So let me call it weighted average. Stores ledger using the weighted average method. So it's the same question, the same figures, but let's look at how it's going to be. So we have the opening balance to be 60 units at $4. So June 1st, the opening balance comes under the balance column, 60 at 4, giving us 240. Then we can underline that. So that is for the weighted average method. And then on the June 2nd, we have a receipt of 100 units at $5 each. Sorry. So June 2nd, a receipt, 100 units at 5, giving us 500. Now, when we come to the balance column, this is how to go by the average. You need to add up your 60 and the 100, and then you add up the amounts, and then you can divide. So watch what I'm trying to do. You watch. 100 by 60 plus 60 is going to be 160 units. Then we are going to add the amounts. So 240 and 500. When you add, you have 740. So if you want to get the unit price here, it's going to be 740 divided by 160, and you will put it here. So you are going to find your own unit price, and that is the unit price that you are going to use for any issue that you are going to make. Okay, so for every addition or subtraction, there is a change in the unit price of the closing stock, and that is what we mean by the weighted average. We find an average price, and the average price is not a simple average. Listen, if it was a simple average, what we would have done is that we have two prices, 4 and 5. So 4 plus 5 is 9. Divided by 2 is 4.5. So we would have put 4.5 here and then multiply by 160. So there is no need. But when we talk about the weighted average, we consider the weight of the goods involved. You see that the weight of 60 and the weight of 100 are not the same. So if 100 is for $5 and then 60 is for 4, you see that when you divide, the final answer here will be more tilted towards the 5 than the 4. In terms of the weight, you see that this is more weightier. Okay, the goods of 100 are weightier than the 60. And so if you put 4.5, okay, it will be like a loss to the 100. So the answer should tilt more towards 5 more than towards 4 in terms of the price, the unit price. And so let us do our calculation. 740 divided by 160. And so when we divide 740 by 160, we have $4.63. All right, so you see how to go about the weighted average. Instead of writing, unlike the FIFO method where we would have written the 60 and then the 100 separate because they come in at different prices. Over here, we are using one price, and it's a weighted average price. So we can just combine the inventory. And then I told you, when you combine the inventory, combine the amounts as well, then you divide. So your 60 plus 100, 160. 500 plus 240, 740. And then you can divide 740 by 160 to give you the weighted average price. So that is how to go about that. So we move on. We are done with the June 2nd. Then we move on to the next date, which is on the June 4th. Receipt again, 50 units at 6. So June 4th, 60 units is coming in at $6. Sorry, 50 coming in. Rather, it's 50 units rather coming in at 6, giving us 300 under receipt. When we go to the weighted average, we are not going to do like the FIFO where we list each of them. No. Add 160 to 50. What do you have? 210. So you see that with the weighted average, you just keep accumulating. You don't list each of them separately. So 210. Then you add the amount. $300 to $740 will give us $1,040. And then you divide 1,040 divided by 210. That is going to give you the unit price. And that is going to give us $4.95. Okay, so you see, as you receive more and more, the unit price continues to change because of the weighted average, the average method. So you just shift it out like that. And then you move to the next transaction. That is on the 7th. June 7th, there was an issue. We issued out 40 units. So now let's look at the issue and the weighted average method. 40. Now, unlike the FIFO where you go and look for first in, first out, over here they are lumped up together like that. So the 40 could be issued straight away from 210. So the unit price, so as at the time of issue, the price applicable at the balance is what you are going to use. Take note, as at the time of issue. So if the next issue, the price has changed, you use the prevalent price. So over here, the price is 4.95. So we are going to use 4.95 to issue. And then we multiply and put it there. So 40 units times $4.95 gives us $198. And then we come to the balance. As for the balance, it's very simple. The unit price has not changed. We take 40 out of 210. We have 160 units. The unit price remains 4.95. So when you multiply, you can get it there. Or better still, you can just subtract this amount of 198 from the 1040, and it gives you your amount at the end. As very easy as ABC. So that gives us $842. So we are done with the transaction on June 7th. Ladies and gentlemen, I don't know if you are getting confused, but I want you to take your time and monitor it carefully. The FIFO is quite different from the weighted average. The weighted average requires that you find averages of price as you add up. But when you are issuing, the price doesn't change at the balance because nothing new has come in. The price only changes when there is a receipt. But as long as there is no receipt, you can continue to issue as many as you can, and the price will continue to be 4.95. As soon as new goods come in, it changes the price. So that is the meaning of the weighted average. It is only a receipt that can change the unit price. Issues do not change the price. So take note of that. So we move on to the next one. June 10th is another receipt of 150 units at $8. So June 10th, 150 units, $8. When we multiply, we have $1,200. Then we move to the balance. When we get to the balance, you know what we do already. Add the 160 to 150. It gives us 310 units. Oh, sorry. I made a mistake. The balance after the receipt on June 7th should have been 170. Okay, yes, but the calculation is correct. And so, yes, it was 170. So when we add 150 to 170, we have 320 instead. Okay, sorry. Okay, so now we have 320. And then we add the amount. Take note, when you are bringing in, the price must change. So what we do is that we add the two amounts, 1,200 and 842. And that gives us $2,042. So we want to find the new price because there is an incoming goods. New goods has come in, so the price must change. And how do we find the new price? Divide the amount by the quantity. 2,042 divided by 320. And that gives us $6.38. In fact, currency must be to 2 decimal places. I know you may have so many decimals, but you have to round them to 2 decimal places. In fact, that is why when it comes to weighted average, final answers may not be the same. They may be different in decimals, but the most important thing is that you are getting the principle right. But make sure you learn how to approximate as well, so that we can all get the same answers. So 6.38 becomes the new unit price. We are done with the transaction on the 10th. This is very easy. I don't know which one is more easier for you, the FIFO or the weighted average. All right. The last 2 transactions, on June 15th, there was an issue of 130 units. So June 15th, we come under issues. We write 130. We issue at the prevalent price, 6.38. So when we multiply 130 by 6.38, it gives us the amount of the issue. Which is $829.40. And then we come to the balance column. When you come to the balance, we subtract what has been issued from the quantity that is available. So that will be, I think we'll have 190 left. And then it's still at the same price. Price hasn't changed. And so our amount becomes 1212.60. So $1,212.60. Then we are done with the transaction on June 15th. So please take your time and look at this very well. The weighted average and the simple average. The weighted average and the FIFO. The simple average would have been easier, but we are not dealing with that. The LIFO is also outmoded. We are not also dealing with that. So we are looking at the last transaction on the 18th of June, which is also an issue. June 18th, we are issuing out 90 units of the inventory. Once there has been no new receipts, price remains the same as 6.38. So you multiply 90 by 6.38, and then you have 574.20. Okay, so now that we have done the issue at the same price, the balance will only change with the quantity. So we take 90 out of 190, we have 100 units at the unit price of 6.38. And then that gives us 638.40. That is if you subtract. Alright, so 638 as our closing balance. Now we are done with the weighted average. Take note of something. Now here should have been 638 if you multiply direct. The 0.40 came about because I subtracted the amount. Now the closing balance for the FIFO, the unit has not changed. It was 100 units, but the unit price was 8, and then giving us an amount of $800. When we come to weighted average, closing balance is still 100 units, but the unit price is not 8, it's 6.38, giving us $638. So you could see that the FIFO reported a higher closing stock than the weighted average. That is the meaning. The FIFO reported $800 as the value of the closing inventory, the same 100 units, but the weighted average is reporting 638. So there are dynamics to this. We are going to prepare a profit statement in our next video, still under the stock valuation. We are going to prepare profit statement where we use this closing stock and then that closing stock, and then from there we will advise management on which method is most appropriate and which one will increase profits. And so that is what is going to be for our next video. And in that video I'm going to solve a full question. That was a past question of the Institute of Chartered Accountants Ghana in 2020, and I'm going to use that to explain how. So we are going to prepare these two statements as well as the statement of profit, and then we'll learn how to advise and which methods to choose in order to increase profitability. But as it stands, this is what we mean by stock valuation using either the FIFO or the weighted average. And like I told you, they will all give you different closing inventories in terms of the value. Okay, so this brings us to the end of part 1 of our lesson on stock valuation or inventory valuation. Remember to subscribe to this channel if you are new. Share this video and let others also have a benefit. Until we meet again another time for the part 2 of this, it is bye for now.